You who have joined, and for all of you who are listening to this, okay? I have high expectations, all right? And if you don't know that about me, then you're in for a rude awakening, okay? You will only learn as much as what you put into this class. There is going to be homework, and I do expect it to be done every single week, okay? If you choose not to do the homework, that is your prerogative. I will not force your hand, but if you come to me and complain, I will slap you with that truth. In other words, I will tell you, you haven't done anything. Don't complain to me. Okay? Does that make sense to everyone? Am I crystal clear on all of that? All right. If you don't put in the work, I will give no shits about you. Period. All right. That's just the honest truth. All right. And you may find it trivial and you may find it stupid, but there's a very specific reason why I do the things that I do. Okay. If you don't like it, you don't want to do it, fine. But don't come to me and bitch at me and say, oh, I feel like I'm learning nothing. People who generally come to that to me say have done no homework, and I promise you, if I put them to the test, they generally fail. All right. So we're here to build a knowledge base, and you also must be able to recall this information, okay, to some degree. Because everything in trading, whether you're a discretionary trader, whether you're a systematic trader, it all depends on your ability to take in information and output something. Okay. And you can't do that if there's nothing in your head. All right. Trading isn't about breakouts. It's not about buying dips. It's about none of that stuff. It's about none of like the technical voodoo. You need to know the stuff, but it's not about that stuff. Okay. And this will make a lot more sense as we go down the road. Okay. So if that sounds harsh to you in any way, I apologize. But like I said, I'm here to teach people who actually want to learn. And that's what you paid for, to be honest. Okay. But I will not cater to you. I'm not going to hold your hand. Okay. If you ask me a question where I feel like you've done no work in terms of researching it, I will ask you, what have you actually done to look this up? Okay. This course is supposed to be designed to give you a solid foundation, but it can't teach you everything. Okay. That's an unrealistic expectation. All right. So please just use your head. If you do that, we'll get along just fine. If you don't do that, I will tell you where the road is. Okay. So just want to make sure we're clear about all of that. Because in the end, it's an individual sport. God's honest truth. All right. I'm not going to be around here forever. You know, you have to do it for yourself. All right. So there's collaboration, but there is also independence. And I hope you guys can understand that both of those things exist in trading. Okay. So I try to make it so you don't always feel like there's a safety net of me being there, that you also understand that you also must be proactive in what you're doing, not reactive. Okay. So, first of all, thank you guys for entrusting me with your education. All right. I take it really seriously because there's a lot of people you can choose to go with. And I hope that I do a good job with it. Okay. So, one thing is I'd like to just gauge the room, and you guys can just type it into. Well, I guess I can actually do this. or maybe not. Good job, go-to meeting. Never mind. But if you guys don't mind, can you all tell me just in the questions box, because obviously no one can see the questions box except me, how many years or months have you all been a part of the market? Meaning you've started to research, you've started to even look at it, or maybe you've been trading. If you guys can just write that in the questions. Nicholas, I like your answer. Very, very specific. Okay. So a lot of you, that's okay. I would actually prefer almost zero. Okay. And Alamon, am I saying your name right? Alamon? Cool. Okay. Um so a lot of you are so I would say the average is probably in this room, I would say about a year, maybe 2 years. Some of you have been trading a long time. That's kind of actually creepy. So, and what I mean by trading, I mean people will say to me, I've been interested in markets for like 20 years, but I mean, how much effort in those 20 years have you actually put forward? So I can, for me, like I can confidently say I've been actively every single day looking at markets for 15 years. Okay. So basically, since I was about 14, 15 years old. All right. Some people can say, yeah, I've been interested in markets for 15 years, but maybe I've only done like a month of studying. Okay. So that's what I mean by that. All right. So, but I just wanted to gauge the room of like people, who have been doing this for a while. Okay. So it's pretty good. All right. So this whole disclaimer, so I don't have to do this every single freaking time, okay? You need to understand that I'm not registered, okay? I am not a professional trader. There is a distinguishing factor of being a professional versus a non-professional. Professional designations are earned, all right? Everyone, Tim Sykes, any retail trader that Tim is a retail trader, I'm a retail trader, Superman's a retail trader. Anyone really from the retail space that decides to, run an education service, we're all retail traders. We are not professionals. Okay. This whole course is for educational purposes only. We will be going into obviously some examples that are show some statistical odds of things, but understand because I'm not registered, because I'm not licensed or any of that stuff, and I'm not an investment advisor, that everything is quote unquote hypothetical, even if I use it in my real life. Okay. Doesn't matter. The exchange assumes everything that everyone does, if they're not registered, is hypothetical in nature. You can lose all your money. Past performance is not indicative of future results, and you just need to be aware with that. Okay, so if for whatever reason you thought I was professional, please understand that I'm not. And you should, if you have any real questions about the market, you should visit a registered investment advisor. Okay? Please type yes into the chat box and tell me that you understand all of this and that you understand that everything we're reading, everything we're doing, it's just all for educational purposes. You guys have also signed something like this away. And if you want to, you can obviously slow down the video and read through all of this nonsense. Okay? And because I'm a systematic trader, there's one more rule. Like I said, everything I do, commission rule 4.41, is basically it's all hypothetical in nature. Okay? So if I don't do that, lawyers get mad. So you got to do it. And my lawyer, he's super aggressive. Like he'll fly down here and slap me. Like he's that kind of person. So, okay. So for those of you who don't know me, name is Matthew Owens. I'm currently in 2017, 27 years old. How I got into trading was I had a stock market competition when I was about 14 years old. My teacher said, hey, if you win this stock market competition, you won't have to take my test. It was like an AP class or an honors class or something. And his class was super hard, actually. So I was like, that's dope. I want to win that. I threw all of my money in Apple at the time. And I ended up winning. And because the stock like doubled in a year. And this was around the time Steve Jobs was coming back. And after that, I was pretty much hooked on the market. Now, I personally, up until like 3 or 4 years ago, kept my interest in the stock market completely secret from my family, from my friends, from everyone. Do you want to know why? Because I didn't want to listen to them tell me that it was a worthless idea. Okay? So that's why I kept it like a dirty secret, if you will. All right. A lot of people didn't even know that I was interested in that stuff. All right. And maybe you guys go through this too, like friends, family don't understand what you're doing. And so it's like, why even tell people? So, and because it's something I really enjoyed, and I just didn't want to listen to other people, especially at my age, being so young, like crush something that I was really interested in. So I just kept it to myself. It was kind of like my own little secret. All right. If you ask any of my family members, if you ask even the closest person that I'm closest to, my brother, he would have told you, yeah, I had no idea. Okay. So, I just really didn't want to deal with it, and I was super fascinated by it. And I was so fascinated because trading to me is the only thing that makes sense. It's you put money in, you get money out, or you lose money. Like it's a fair trade. Stuff like going to the grocery store or buying something with money doesn't make sense to me because it's not like a goods to goods comparison. So like an apple for an orange, that makes sense. But like money value in terms of a fair trade does not make sense to me. Okay. And kind of after that whole experience of winning, I just kind of ran with the entire market, the crash was like kind of a huge thing for me because I was like, oh my God, that's insane that could happen in my lifetime. Okay. I won't go into the details of my whole story, but that's pretty much how I got started in it. And I've been doing it ever since. All right. So what you guys see in terms of what you all think is my success is really the end result of a culmination of over 10 years of doing something and learning about something, okay? Doesn't mean I know everything, but I know quite a bit, okay? Another thing that never gets explained to people that I realize is like, why did I choose the name Triforce as a pseudonym? It really just came from the fact like, people generally have online identities, but the whole Legend of Zelda game was a big thing in my life too. And when I found trading, it was kind of like an awakening for me. And if you don't know anything about the video game, it's pretty much about a boy who basically like sleeps his life away, and then he gets awakened for a purpose. And so that's kind of the whole ideology behind Triforce Trader, okay? Because that's how I felt about trading. And like I said, been doing this for a while. I've had many mentors in my life, not only through reading, but people that I've paid for, like Superman, who you guys have probably heard of before. The difference between my mentor and in terms of like people who associate me with Superman is the fact like I don't trade like any other trader in the retail space. I trade more like if I was in the hedge fund world, there'd be a lot more people like me than there are people who are discretionary. And what I mean by that is I am a quant, okay? Meaning I use systematic evaluation of things to determine trade ideas. All right? So what's the probability of X working? If you look at my mentor like Superman, he's not like this at all. And people often ask, well, then why did you join his course? I joined his course simply because I had never knew any, I never had met or seen anyone that did fundamental analysis. And so I kind of wanted to understand, like, why does a trader choose to do fundamental analysis? And that was kind of my whole thing of just joining his service. But for me, Superman ended up playing a bigger role because at the time, my mom got cancer, and I was just kind of really starting my trading journey. And he played a big role emotionally for me in terms of like keeping me grounded. Okay. So call it a twist of fate, but Superman's main role in my life was really just to be, someone in the trading world to kind of be like, hey, shit happens, just keep your head on straight. You've got good stuff going on. And he talked to me a lot about like his boom and bust cycle. If you don't know, Superman has gone bankrupt before. I don't know what that's like, but yeah. So Superman for me was a big part in just keeping me even keeled, and everyone in his chat room. Okay. But I've read many different people. I think people have a lot of mentors in their life. I don't think it's just one person. If you're really honest with yourself, we all learn from different people, different things, because different things that people say resonate with you. Okay. You're never going to like the person completely, right? Like you're just going to like bits and pieces of them. That's usually what it comes down to. Okay. So that's kind of my background in trading and as a whole, and kind of what's most recently happened in my life. Okay. So this is my track record, also answering the question of why I'm qualified. Okay. So I have two accounts that show track records. One is Triforce Trader, which is a culmination of different quant strategies. And currently, this is most current, $1.4 million in profit, worst average drawdown, 14, long trade, 13, short trade, 14. And you can see my long trades are way worse than my short trades. Why? Because there are very few short trades, but they're generally more profitable. And you can see also too, oh my God, you guys don't see this entire thing. Holy shit. Okay. And then can you guys see it now? Okay. So then there is so you can see like my largest winning trades is like 36, and my long trades 31, and the short trades 36. Okay? So you can see that I'm not making what $100,000 a round trip. That to me is always dangerous, because you're going to have these like large trade size of winning trades, but the amount that people have to put up to make that money is absolutely absurd. So I'm all about consistency. All right. I don't really care about huge outsized returns, although it's nice. but it's all about the process and it's all about consistency. Okay. So this is one of my track records on Profitly. There's another track record. This is my algo system. This is only one system. There's 10 algorithms. It's purely systematic. You can buy these, obviously, and I have them on TradeStation, so you can automate them. And the purpose of me putting them on Profitly to show a track record in real time is the sheer fact that I want you guys to see that this beats 90% of traders, okay, in the retail space. This is only trading one contract. That's the lowest amount that you can trade, okay, for in the futures market, which is what this trades, which we'll get into. But the point of all of this is it's all about consistency, okay? This is a thing that's just giving buy and sell alerts, okay? And if you want to, you can automate it in real time and trade it. Will this last forever? I don't know, okay? But I did this specifically on Profitly because I want people to see, like, it's not about these huge outsized returns. It's about consistency over time, okay? And the question I always ask people is did you do better than this thing? And if the answer is no, then you really need to evaluate yourself. Is discretionary trading the best way to go? Okay? So that's kind of the difference between the two. This is just one set of strategies, Norman, and the other one is this is a culmination of many different strategies that I trade. Okay? This track record has these trades in it, just at a bigger, I trade 5 contracts instead of 1. So it's like 5 times the amount. But this is kind of like a culmination of, 50 to 100 different kinds of systematic strategies. Okay? I wanted to separate the two because I wanted to just show here's just one set of strategies that I have. It has 10 algorithms in it. Okay? Does that make sense, Norman? Yeah. So they're all systematized. Okay. So moving on from there. So let's get into the basics of everything. And that was just kind of to show like why I'm kind of qualified to trade, so to speak. So we're going to talk about stocks first. So the way this course is structured is we're going to talk about stocks, we're going to talk about options, and we're going to talk about futures right off the bat. Okay? We're just going to try to get a basic knowledge of those things before we move on to anything like technical analysis or fundamental analysis. Okay? So, what is a stock? A stock is a share of ownership in a company. And a lot of people tend to try to buy, in the stock market world at least, for a lot of people, not day traders, but for most of the regular world, they're buying shares of a company to have some kind of ownership in that company. Okay? So if you take an example like Apple, now this is an old example, but it says if Apple has approximately 892 million shares outstanding, okay, what's known as shares outstanding, if you buy 1,000 shares of Apple, you would own 0.0001% of Apple. So you just take 1,000 divided by 892. So if I wanted to own 1% of Apple, I would need to buy in this specific example, 8.9 million shares. Okay? But the concept is share is just a piece of ownership, allegedly, in a company. Okay? A lot of people don't know this, but if you were to buy a share of stock, this is the way it used to be, which is it was actually represented by what's known as a stock certificate. So before electronic trading, a stock certificate was just like a legal document that would say this is how many number of shares that you have. Okay. You can actually still get these, I believe, but no one does, because literally when you're buying and selling shares, this is what you're doing. Okay, you're actually just trading these quote unquote certificates. Okay, so in the past, when people bought, they would receive the actual physical certificate. If they wanted to sell them, they would take the physical certificates down to their broker. These days, you will not see the physical certificate unless you want to order them, as the certificates are held electronically in the broker's name, known as in street's name. All right. So when you're buying a share of stock or you own stock, this is really what's happening. Okay. So having the broker hold your shares in their name does not diminish your rights to the ownership. Uh, Most people nowadays, I don't know, I've never seen anyone with a stock certificate before. Uh, Most of it's just done electronically. Okay. So the next thing we want to talk about is the exchanges for the stock market. So stock exchanges provide liquidity. This can also be known as volume. All right. And I'm just going to leave it like that. But I want you guys to understand that volume and liquidity are two different things. Okay. And we'll get into much greater detail about that down the road. But for now, just understand that stock exchanges provide liquidity, meaning they try to find a buyer for every seller. Okay. And your job as a trader is literally to provide liquidity. So the New York Stock Exchange is one of the exchanges. It's considered to be the most prestigious. There were specialists on the floor physically specializing in the trading of stocks, but this has obviously gone away in the advent of technology. All right. There are, for the New York Stock Exchange, specific listing and maintenance requirements designed to protect the quality of stocks, mainly blue chip stocks. Blue chip stocks would be something like Apple, Campbell Soup, all right, and medium to large cap companies on the New York Stock Exchange. The NASDAQ is another exchange. This is where buyers and sellers are connected by computer. Market makers, or or dealers, hold their own inventory of NASDAQ stocks and stand ready to buy and sell. Now, these market makers, again, they're not people anymore. They're actually machines. Okay. There are some people still on the floor. Their job is literally just to make sure that the whole network of machines doesn't just collapse. Okay. And if it does, they can be there to also manually do stuff. All right. But it still hasn't changed. So there's still market makers there ready to buy and sell to help create a market, whether it's a person or a machine. They must post their bids and their asks. They can have a lot of influence in a stock. Specific listing, again, there's still specific listing and maintenance requirements designed to protect the quality of stocks. And on the NASDAQ exchange, you will generally find mainly small, medium, large cap technology companies on the NASDAQ. Okay. Now, if I ever trade stocks, in the event that I do, I would only trade, whether it's a penny stock, whether it's any kind of stock, I would only trade them if they are NASDAQ or New York Stock Exchange listed. And the real reason is because there are maintenance and listing requirements that are, I think fair. And there's not a lot of games that can go on. Okay. There's the other side. So a lot of people don't understand this either. So if a stock goes under $1 for more than a month, all right. So if you have a company and your stock goes under $1 for more than a month, you can be put on the OTCBB or the pink sheet market. Okay. So if a specific stock doesn't meet that requirement of $1, or something happens to the company, this is generally where they will go. Okay. David Jones, Dow Jones and S&P 500 not recommended. I don't know what you mean by that question. Do you mean like trading those things? We'll get into that. That's where the futures market comes in. But the New York, these are just exchanges, David. So, like, Apple is on an exchange. It used to be, I believe, on the NASDAQ, but now it's like, well, no, I'm sorry. These are just exchanges, so it's like the New York Stock Exchange is just a place where all of, the stocks are. The index is a culmination. So like the S&P is a culmination of all those stocks into one index. So if you buy the S&P, to facilitate the buying and the selling, you're going to have to go through one of these exchanges. Does that make sense? So these exchanges are the hub, basically. All right. So if you want to buy and sell shares, like, you're going to go through the exchange, okay, of a certain company. So this is like the intermediary. All right. These are the people that actually give you that liquidity to buy and sell through, and quote unquote transparency. So if you buy here, your order gets filled through the exchange. Okay. So another kind of exchange is the OTC market. So if a stock falls under like certain listing requirements, or the company is found out to be fraudulent in any manner, that stock no longer gets the benefits of having a regulated exchange in terms of the New York Stock Exchange or the NASDAQ. They generally go to the OTC market. The OTC market still functions like the New York Stock Exchange and NASDAQ in terms of the OTC market allows buying and selling of stocks, but it's not as liquid, number one. And secondly, there's a lot less regulation in the OTC market. Okay. So in the OTC market, you will generally find many fraudulent companies that have been listed there in the past. So think like the Wolf of Wall Street. Okay. He was basically selling people pink sheets and OTCBB companies. All right. Companies that were worth pennies on the share. They had no earnings, no nothing. Because on the OTC market and the pink sheet market, there's not a lot of regulation, and therefore there's no minimal sales for asset requirements. They can literally lie about their companies. There's not a lot of oversight. Okay. And the only thing though is that the OTC companies still, they have to register with the SEC. So they still have to give, a filing about their company. All right. What's known as, we'll get into that when we talk about fundamentals, but basically just understand that if a company, this is like purgatory for most companies. That's the best way to think of it. So they couldn't cut it on a normal exchange. They either were fraudulent or their stock value fell below for a certain amount of time. The New York Stock Exchange says, and the NASDAQ says, hey, there's something weird going on with your company, or it's now deemed a penny stock. We're not going to provide our services for that. So they kind of just shove it down into this OTC market. And in the OTC market, you have OTCBB, which is over the counter, or you have pink sheets. Okay. But the exchange itself, like where the mediary is called the OTC market. All right. Does that make sense to everyone? Hopefully so. All right. We're just covering the big kind of exchanges. And there are more. All right. But the ones that New York Stock Exchange, NASDAQ, those are the most what people are familiar with. And then the OTC market is basically, if your stock basically sucks, it goes there. Okay. So that's kind of the hierarchy of it all. All right. So let's talk about market capitalization. So a lot of people ask themselves this question when it comes to stocks or commodities. It doesn't matter. A question that always gets asked from the get-go is like, what makes a stock move up and down? Okay. So you need to understand that the market is all about supply and demand. Supply equals those willing to sell a stock. Demand equals those willing to buy a stock. So if the supply side is stronger, then the stock price will go down. If the demand side is stronger, then the stock price will go up. That's really what makes a stock go up and down. Okay. Is this kind of like supply demand battle. So the most challenging part, though, is, and what I aim to teach you throughout this class, is to understanding and anticipating why a stock price moves up and down. So in stock specifically, which is what we're on, the value of a company is not the stock price, all right, but the actual market capitalization. So market capitalization is the stock price multiplied by the total number of shares outstanding. Shares outstanding is basically how many shares are available to buy and sell for retail or investors. And then the stock price, so this is the most current stock price of Apple, is $146. So if you look down here at this little sheet, this little tear sheet right here, so Apple closed at $146.28, and it has approximately 5.21 billion shares outstanding. Okay, this tear sheet also just tells you what the market capitalization is. So this means that the value of the company is probably right here, $762 billion, because you would take 5.2 multiplied by the stock price, and that's 146. All right. So that is the market capitalization, meaning this company is worth, on paper, with all its assets, everything is worth this amount of money. That's the market cap. Okay. So some terminology for market capitalization, and focus on this pyramid because I think it's the easiest way to remember this. But so you have large cap and mega cap. So mega cap stocks are any company that, and there's not a lot of them, but it's any company that has assets that are worth 200 billion or more. Okay. So if you ever hear someone say, I'm trading this mega cap stock, or I like mega cap stocks, that's what they're talking about. Okay. And then a large cap stock is any company that has a greater than 10 billion. And then these companies tend to be the most stable and are generally very slow moving in terms of price. Then there's mid cap stocks. These generally have a net value of anywhere from 2 to 10 billion. These tend to be slightly risky than large cap stocks, but less riskier than small cap stocks. They tend to offer more growth potential than large cap stocks. Then you have small cap stocks underneath. So if you ever hear someone say, I trade small caps, this is what they're talking about. They have less than 2 billion. The good ones offer the strongest growth potential, but have more risk of failure and tend to be more volatile. These stocks will generally underperform in recessions, but tend to overperform in bull markets. And when we get into some examples, you'll see that like there's been a lot of small cap stocks that have really outperformed the general market because they've gone insane. Okay, we're talking about stocks that go from like pennies to dollars in matters of days, and this is a sign that you're actually in a bull market. It's just one of like a pulse, if you will. Micro cap and ultra cap stocks. So these are stocks that generally have a market cap of 5 million to 2 billion. And ultra, these are really what's known as thin because there's not a lot of buying and selling going on. These generally have they're 50 million or less. These have the highest risk reward profile, okay, in terms of volatility. So the opportunity for extreme growth exists as well as the opportunity to lose your investment by risk of failure. This is the most likely thing to happen, okay? So micro cap and ultra cap stocks, I mean, if you're gonna trade them, just be really careful. I don't ever really trade them. I would never go out of my way to ever trade them. I have in the past though. And all volatility means is like you have these expansive moves up and down that are absolutely insane. Okay? But that doesn't mean that there's enough buyers and sellers to get out of those when things go wrong. Okay? So understand that as well. So that's kind of the sublimation of just like what is a stock. So remember, it's, you know, just trying to purchase something via shares. You have the exchanges, New York Stock Exchange, the NASDAQ, and then you have the OTC market. So those are the big exchanges where you can, they're like the intermediary where you can buy and sell anonymously. You know, if you want to buy a share of stock, it goes to the exchange fills the order, and then you get a confirmation back saying like your order was filled at X price. Okay? Is any of that unclear to anyone at this point in time? And then you need to understand too that you have the way stocks are categorized is, you know, you got mega cap, you've got large cap, you got mid cap, you got small cap, and then you have like these really thin stocks where you see like just by their name, there's not a lot of shares of buying and selling going on. Okay? All right. So before we move on, I just want to make sure, is everyone clear on this? Give me a yes. All right, good. So now we're going to go into futures. Okay, and this is where generally a lot of people get confused. But the thing is that futures and what we'll see are really no different than stocks, meaning there's an exchange, it's known as the CME, okay? There's buying and selling going on. So instead of shares, it's known as contracts, okay? So, but shares and contracts don't equate to the same thing. 100 shares is not one contract. There's no equilibrium there, okay? So pay close attention. If you have questions, please stop me, okay? Because this generally confuses people, especially when we go from stocks to futures. But we're just going to go over the basic terminology of futures and that the futures market itself. Futures is what I mainly trade. I'm not really much of a stock trader these days for a lot of reasons, which we'll get into. But, you know, if you need anything or nothing's clear, please let me know. Okay. So, futures, what they are, all right, are a lot like options. They're known as what's financial derivatives, okay? Meaning that their value is derived from something else, all right? So, for example, down here, we have the S&P Spider, what's known as SPY, okay? And the S&P 500 is a culmination of 500 of the best stocks together. Okay, it's not an exchange. Remember, an exchange is just a place where people go, like a market, if you will, to buy and sell. The S&P 500, though, is a culmination by certain criteria of the best 500 companies in the US. Okay, and the value of the S&P is the culmination of the value of simply the value of all of those 500 stocks. All right. So there's something known as SPY. Now, SPY is not a futures contract. It's what's known as an ETF. Okay, but ETFs are also derivatives. And what this does is all it does is it tracks. So this is the index on the right hand side over here. Okay. And all it's going to do is it's going to track this guy. So SPY is just going to look at this guy and it's just going to trade pretty much similarly to the S&P 500. Okay. In the futures market, we have what's known as the E-mini, or we have the S&P future, which again just tracks this big guy right here. So if this market moves up, then we would anticipate that we would see SPY move up. We would see the S&P futures contract move up. We would also see the E-mini S&P 500 go up. They're all tracking this underlying thing. That's what a financial derivative does. Okay? So this whole example is really just to show you like what is a financial derivative and why it exists. And it's basically, it allows people to buy and sell off of a commodity like oil, or in this case an index like the S&P 500. And there's another thing like an ETF, which is not a futures contract, it's a derivative though, that also does the same thing. Okay, but the main purpose is it's just a derivative. The only reason I had to use SPY here was because I wanted to keep these two graphs the same, and there wasn't really a good one for the E-mini S&P 500, and I didn't want to pull something from my platform because it would look completely different in terms of like the way that the chart is structured. All right, consistency. Okay, so one thing you need to know about futures contracts though is, hold on, we got a question. So it's a derivative, is the S&P. So SPY is a derivative of the S&P. So the main, let me go back here. So the main thing is you have something, all right? And then, so like if you had gold, right? Let's say you had bars of gold. You could create a derivative contract that would just track the price of what gold is going up and down, up and down, up and down. In this case, the main focal point is the S&P. You can't just, there's no way, there was nothing to trade the S&P, okay? So someone came along and said, how about we just make this derivative thing that tracks the S&P, and then people can buy and sell that derivative that tracks the S&P. Does that make sense? So back in the day, people couldn't buy and sell the S&P, the index itself. Someone had the ingenious idea of just saying, okay, well, if we can't, there's no instrument to trade this. So we have this thing that we created that's like a composite. There's nothing we can trade. How about we just make something that trades like it? And then a derivative was born. Does that make sense, Alman? That's right. Okay. Or in the case of an ETF, it would just be shares, just like a normal stock. But again, SPY doesn't have value. It's only tracking the value of the S&P 500. I know that's confusing, but think about it. So, backwards in time, when all these people were like, okay, we have this index that we created. So like the Dow Jones Industrial has been around for like 100 something years, right? And then you have the S&P 500, which is a newer composite, which is started in like the 1960s is when people actually put it all together, okay? But people were like, well, why can't we trade that? And someone was like, well, there's just no instrument to trade this on. Like, what are you going to do? Just buy 500 companies? And they're like, yeah, we don't want to do that. So what they did is they said, here's this index thing. Now we're going to make this futures contract or this derivative of that's just going to track the S&P, okay? And we'll give those contracts certain point values of what you can make or lose. Okay. It's not necessarily a difference. Okay. It's just like you see that it's 243 and this is 2438.30. Okay. 24th 243 is the same as 2438. Okay. The purpose of this is not to get into like why SPY is mathematically formulated different. It's just to understand that the concept, if you look at these two charts, like they're pretty much identical. Okay. The purpose is like what is a derivative and what's its purpose, and its purpose is just to track. So if this goes up, this goes up. Okay, the underlying thing that it's supposed to track. Okay, so um, this is done by an equation. This is also done by an equation, but someone is can buy shares of this ETF at $243, which is generally a lot better than buying shares of something at 2,438 because it's a derivative. And derivatives were also created so that retail traders could actually have exposure to the market. Okay? So instead of buying all 500 companies to have exposure to this index, they made it so that people could just buy something relatively cheaply to have the same exposure. Okay. Yes. So Norman says so if the S&P goes up 1 point to 2439, then the spider would go up to 24. I don't know what it would go. Yeah, it would be like 2444, Norman. That would be like a reasonable thing to say. Okay? Yeah. Because remember, like I said, these derivatives, like, they were not like no like back in the day no one could buy and sell the S&P. Like if you wanted to have exposure, so imagine being a portfolio manager in like the 60s and 70s and you were like, yeah, I may have millions of dollars, but I can't buy all 500 companies, right? So what they did was is they said, okay, we're going to make this product known as futures for the S&P, and we're going to allow you to have exposure to it. Now, you need to understand though, futures contracts have existed for a really long time. There were other things before the S&P, like gold. The first futures contract was in 1974, I believe. Um, there had been other derivatives of futures. So in the case of gold, it tracks what people are willing to buy and sell gold at the current price. Okay? So, but instead of buying physical gold, they made it so there was a derivative contract so you could buy and sell. Does that make sense? Is this making sense to everyone? Am I not explaining this correctly? It's just a way for people to have exposure to something without owning it outright because it's too expensive to own it outright. Okay? So derivatives didn't really there were futures contracts before the S&P, but what made them super popular was that no, the futures contract is the derivative. The derivative is the underlying asset. It's just tracking the underlying asset. So you have this thing, okay? And then you can't trade this thing. So a derivative was created to track this thing. So when it goes up, this goes up. If it goes down, this goes down. Okay? And it allows you to buy and sell and have exposure to this. Okay? Very simply. That's what it is. No, I just gave this as an example, like I said, Norman. There's no reason to trade ETFs if you're going to trade futures. Okay? Unless you want to like do options or something. Okay, so futures are among the oldest derivatives contracts. They were originally designed to allow farmers to hedge against changes in price of their crops between planting and when they could be harvested and brought to the market. As such, many futures contracts focus on things such as livestock, cattle, grains like wheat. Since these beginnings, these futures markets has expanded to include contracts linked to a wide variety of assets, including gold, industrial metals, energy like oil, bonds like treasury bonds, and stocks like the S&P 500. So Alan writes, so from an perspective of an investor, wouldn't it be wiser and safer to hold into this as opposed to one individual great company like Apple? Yeah, Alan, reasonably so. So there is no difference between SPY and, well, okay, SPX is a different kind of ETF. I'm not getting into ETF, guys. It was just an example. We got to stay on message here, okay? Not all these questions about this ETF or that ETF. It's all about just understanding what a derivative is, okay? So hopefully you guys understand what a derivative is. All right? So that's all it was meant to do. So futures contracts are different from stocks, but the underlying security of a futures contract may be equity security or maybe equity securities. Futures contracts cover a wider universe of underlying securities than just stocks though. Futures contracts may be made on commodities like gold or oil, interest rates, or even the weather. Okay, isn't that weird? You can bet on the weather. A futures contract is a contract between two parties in which the parties agreed to sell and buy a set quantity and quality of some asset at an agreed upon later date for an agreed upon price. Futures prices also trade on exchanges just like equities. Today, just like equities, most futures contracts trading now takes place over an electronic system. Both the both the Chicago Board of Mercantile Exchange